Since 1998, when I started in the financial business, the question that I seem to get is definitely in the top three is, what do we do to educate our kids? How do we help with financial literacy for our kids? Well, I've gone out and asked for some videos that I could react to. So I'll be watching it for the first time with you, but this is Financial Literacy for Kids. Learn the basics of finance and budgeting. Let's take a peek.
Financial literacy for kids. Have you ever seen something in a store you really wanted to buy? Maybe someone even told you, save your money and you can buy it some.
By the way, there's this Benjamin Talks company that I met with the two co-founders. And rather than putting stuff in a piggy bank where you know the kids can't see it, it's got three clear things for saving and giving and spending. So I really like that. Just thought of it. I have a children's book coming out January 2nd of 2024 with Julia Cook, a brilliant author, and it's called I Am Money and I Don't Grow on Trees. So, this is something that's definitely part of my life right now. It's something that I'm working on with my own kids, even though we're a little bit older at 15 and 18 years old. And this is for the younger crowd, but the kindergarten through 3 is the book that I wrote.
Someday, how do you earn money to buy things you want
I like the clear jar better. There we go.
or need? Today, we are going to define and explain certain words and phrases that will help you become more financially literate. Let's grab our friend, Frankie Finance, to help us along the way. Needs and wants. A need is something you must have to survive.
So I use the word need like sparingly because a lot of times people say they need something, but they don't really need it. It should be followed with in order to. I need this in order to, whatever. But it's usually a word that is used or misused. Most of the time it's a want, but people say need.
Like food, water, clothing, and shelter.
Yeah, the food and water, absolutely. Clothing, yeah, I mean, you could probably go be in some nudist colony, but yeah, this is for kids.
A want, on the other hand, is something that would be fun to have, but you can live without. Like a skateboard, video game, or favorite toy. Knowing the difference between needs and wants can help you be more responsible with your money. Making a but.
I mean, part of what we're talking about or getting into here is mindful cash management versus budgeting. A lot of people, when it comes to money, they think that the road to get ahead is to cut back, but no one shrinks their way to wealth. So teaching the kids basics is really critical, but the biggest thing is to invest in themselves, to find out ways that they could add more value that leads to earning more money because money follows value. And how do they develop their skill sets? And how do they reach more people or impact the people they reach more deeply or find a more fulfilling career? I think that budgeting, there's a way to just pay yourself first, right? Automatically save, then deliberately invest. Budgeting is usually about constraint and reduction and is good for people who are a train wreck and might be good for some of the fundamentals here. But I do think that we'll look at some other options that might be a little bit more efficient, easy, and automatic.
Budget. A budget is a plan for managing your money. It is based.
Yet when people think about budget, they usually think about cutting back first, living within their means by reducing what they're spending. And the word expense has a negative connotation. And so I like they say there's needs, it's required to survive. Wants is something fun, but you can live without. That's a good distinction because I do think that a lot of times people get caught in what I call the consumer condition where they think buying more will make them happier. And that doesn't necessarily always equal happiness as buying more. Sometimes, especially if it's on a loan or they owe money on, it could become more complicated. There's more to manage or it becomes something that feels like pressure. And yet people often do that because they think it adds societal value or happiness, but it's just renting happiness, not actual long-term sustainable happiness.
On your estimation of income, the money you earn or receive as a gift, plus your expenses, meaning the money you spend. One of the main reasons to create a budget is to help you live within your means.
Okay, there we go. Live within your means. Knew it was coming. There's 3 ways to live within your means. Number 1 is to reduce expenses. And again, for people that are spending more than they earn, that's a necessity. But there's two other ways to be more efficient within your means because you save the most that you can on taxes legally and ethically. You pay the least amount in interest because you design things properly by having the right credit score or the right collateral that could lower those interest rates or the right credit reporting, right? Or the cash flow reporting, I'm sorry, or even the right connections. So it's really about, not overpaying on investment fees that don't add to the bottom line or on insurance costs because you have improper structure. And so I want efficiency to be part of that. And of course, expansion by expanding your means. I want people to think about adding more value, enjoying more by giving more, not just what they can hold on to or scrimp or sacrifice with, because that leads to a scarcity mindset, and scarcity is a destroyer of wealth.
In other words, a budget can keep you from spending money you don't have and avoid.
True, but also just paying yourself first. Automatically setting money aside from every time there's a deposit, automatically putting a percentage away. My recommendation is 18%. And if you can start early enough, you just learn to live off the rest. And that's because we need to battle things like inflation, which erodes money. And we need to have purchasing power in the future, tax fluctuations, just the basic cost of goods going up because of inflation, or because we enjoy things more when we get older, or like I didn't know the taste of dark chocolate would be so good, or whiskey when I was younger, or coffee that I didn't even really get into until I was in my late 30s. So, or even nice restaurants, because I grew up, in a small town where we didn't really have fancy or really nice restaurants. So we have a luxury once enjoyed kind of becomes a necessity. So whether it's tax hikes or interest rate changes or inflation, or we have to buy things that we have to replace because of something called planned obsolescence. Like, I want to think efficiency and paying ourselves first, expansion and paying ourselves first. It goes in hand, no matter whether you're just finding the money, having an account that it goes into that's not your spending account. Or if you're earning more, always taking a percentage. So even when you make more, that percentage stays the same and moves it over. That's the 18%. And the last part of the 18%, it's really 15% for all those eroding factors. And 3% that's just there for you to enjoy, and what I call a living wealthy account that helps you with quality of life along the way. So it's not just about one day, someday.
Going into debt. A debt is money you borrow from someone else that must be repaid.
Okay, I hate to be overly technical here, but I'm going to do it. Because debt is when you owe more in a liability than the asset. It comes from a balance sheet. Balance sheet is assets versus liabilities. If I get an asset that's $100,000, but I have to borrow $110,000 to get it, I'm $10,000 in debt. Most people say you're $110,000. Well, we have to look at debt in relationship to the asset attached to it. If I could borrow 10 grand to get a $100,000 asset, I have $90,000 of equity, which is the opposite of debt. And these are the technical definitions: equity or debt. Debt is a function of owing more than you have. Equity is having more than what you owe. And so there's loans, but most people say if you have a loan, you're in debt. That's not necessarily true. We have inefficient loans or effective loans. We have different types of loans. Consumer loans, where you borrow to consume, that's going to lead to debt. But and people have to be careful based on your knowledge if you borrow to buy an asset, because it doesn't always mean that asset will be worth that amount or that it's always going to produce. And if it doesn't work out, you could still end up with that loan, and it could eventually flip and become a debt versus equity. So a debt is not money you borrow from someone else that must be repaid. A loan is money you borrow from someone else that must be repaid.
Saving versus borrowing. As you can probably guess, saving is when you set money aside for the future and do not spend it right away.
Okay, that's good. I'm fine with that. But savings versus investing are two different things. Savings are safe. They're available. They're liquid, which means they're available, right? So available or liquid, and without high risk of depreciation or loss. Now, it might still have inflation that could be eroding it, but ultimately, investing is when we're allocating that money to try to grow it. So savings is setting it aside. Investing is attempting to grow that. And those are two different things that often get collapsed.
Like if you are saving up for a special toy or activity, you might have a
I understand. I'm speaking to the adults here, and this is a kids video, but as you're teaching kids, I just want you to take these things into consideration. One of the most important things to teach them is what's called cost of money, right? Like, what could they earn on their money, or what do they have to pay to borrow money? Both of those are cost of money. So if I could borrow money at 2%, but I knew for certain I could get 3%, I actually might choose to do that. But for most people, it's best just to pay these things off so that you don't get into a bad situation where you owe more than you have. But ultimately just understanding like, hey, look, if I have money that I can only earn 2% on, but I'm paying 5% for my loans, why not pay those loans off? Because I'm going to save more than what I'm earning. Cost of money helps us to make better financial decisions and understand what our alternatives are. So no one should just say, oh, no matter what, never have a mortgage. No matter what, never have a car loan. No matter what, because it's contextual. It depends on the situation. Where for some people, that's their objective, is to never have a single loan. And that's great. If they can make life work that way, fantastic. But other people, like me, might be comfortable having a mortgage and having enough money to pay that mortgage off, knowing that my mortgage is at 2.75%. And right now, I can put money at 4.5% with high levels of risk management because of treasuries, right? Which are government-issued bonds. So anyway, just understanding what you could earn versus what you pay. And look, if you have a 29% interest rate credit card, that's the most expensive thing you could probably have. Paying that off is probably better than almost any investment than you could make, depending, of course, if you just have this really specific, perfect opportunity at the right time.
Piggy bank at home where you put money that you are saving. Or you might even have a savings account at a bank. Have you ever heard of a loan before? A loan is
exactly what they said debt was, right? And this is almost the same definition.
Money you borrow from someone. Borrowing money means that you are expected to pay it back. Most often, a loan is given for a specific reason, like to help purchase something big, like a house or a car. Quite often, you will have to pay interest on the loan. This means the bank expects you to pay the full amount back, plus an extra charge for borrowing the money in the first place.
I like that definition. I think they did a nice job there.
This extra is called interest and is a percent of the borrowed amount. A savings account is a place where you put money that you intend on saving for a while. And guess what? You can actually earn a...
Saving for a while, I mean, maybe, hopefully, but not 100% necessarily. Like, I believe you want to set up at least 6 months of your expenses in a savings account. But that savings account might be some in cash in a safe, some in gold and silver, some in, dare I say it, Bitcoin, even though that's going to be really volatile, and maybe a little bit at the bank. And then beyond that, there's other places you could save your money, like cash value insurance that could do better than a savings account with more benefits and protection, but requires more time to hit break even or to get ahead. So there are some more considerations, but this is nice basics overall.
A little extra money while your money is in the bank. For real.
And by the way, this is why Julia Cook is such a brilliant co-author, because she knows how to make this so fun and relatable to kids. And I'm so excited about the message in the book. I'm here talking to you as an adult, and I've tried to teach my kids some of this stuff, and sometimes I'm over their head now that they're teenagers. I seem to be able to communicate really well.
Also called interest. But instead of giving money back to the bank for a loan, it is a little extra money that you earn.
And the way I would say all this is you always pay interest, whether you pay cash and forfeit the right to earn interest, as we see here, or you borrow and you pay interest to either keep access to your money or it's because it's money you don't have. But either way, there's always an interest cost, whether you pay cash or whether you finance. One is much more seen, and the other one is more, what did you miss out on, or what could you have had you not done this?
Earn while your money sits in the bank. A checking account is another kind of bank account that you can use to pay bills, either by check.
And probably not by check. I mean, let's face it. Most kids aren't going to use checkbooks. They're going to be using apps and doing transfers and using credit cards. So I think that we need to kind of really take this into consideration, because when I was a teenager, I sat down and had a ledger that I balanced, but now I just go into my accounts on an app and I can make all the transfers, use, Venmo or PayPal or whatever that might be, or just move it within my own bank because of the app that they have created for me. So, you could use a check. Maybe it's not the worst thing to teach them about it, but it's probably not that valid.
or buy a special card called a debit card. Checking accounts do not earn interest.
There's actually some checking accounts now that do. Morgan Stanley has a checking account paying out really high interest rates. So there are some exceptions to this, but I understand that that's in general what's being said.
Credit versus debit. A credit card is a small, hard plastic card that is issued by a credit card company or other financial institution. They are basically a type of loan because using a credit card means you are borrowing money from the company who issued the card. Here's how it works. The credit card company loans you money, and you pay it back according to a schedule. This is usually one payment
And you can pay it back whenever you want, not just according to the schedule, just a technicality.
per month with interest on the unpaid amount.
Yeah, and if you pay it within a time period, there will be no interest, and you can use that for up to 30 days.
On the other hand, debit cards are linked directly to your bank account.
Which also mean that sometimes debit cards have more risk from a standpoint of fraud or being stolen, where there's a lot more credit card protection. And people do like to use credit cards to get bonuses and points and stuff like that. But again, sometimes they end up spending money they don't have.
Which means you use your debit card to pay for things with money you already have in either your savings or checking account. Want to learn more? We have more videos that go into more detail about each of these skills. For now, let's review what we learned today. True or false? Checking and savings accounts are basically the same exact thing.
Cool. Like doing a little test there.
Money that you are planning to save for a while and earn you interest. Checking accounts are used to pay for bills and other immediate needs and wants that do not earn interest.
Although I have a decent amount of money sitting in checking accounts that I don't plan to immediately use. It's just there as part of the safety net.
Fill in the blank. A blank is a plan for managing your money.
They're saying budget, but I say mindful cash management, or other people have said conscious spending plan, or there's a different way to think of this, not just as constraint, but not just reduction, production. So automatically paying yourself first in a separate account, that's using a wealth capture account structure, which is my recommendation.
Budget. What is the difference?
And look, this matters because I don't want them to get this language and these philosophies at an early age that says you got to miss out on life and you got to hope that people will just give you more, instead of thinking like, what if I invested in myself? What if I increased my skill sets? What if I learned how to make more money? I mean, I get that's why a lot of people go to college, but it hasn't been as effective as it used to be because of today's society. So a budget is really for those people who don't know how to manage money or don't have an automated savings plan and spend more than what they make. But if you could pay yourself first to live off the rest, you don't have to spend all your time scrimping, sacrificing, pinching pennies, coupon clipping. If you just learn how to add more value, serve more people, solve bigger problems, and not get into, too many loans that would put you into debt where you owe more than you have, and now you feel like you're behind and you have to push just to make those payments, which means you don't have enough to cover the basics or to invest back into yourself, and it gets a lot of people stuck and in traps.
Between a need and a want.
Needs for survival, wants optional.
Need is something you must have to survive. A want is something that would be fun to have, but you can live without.
So I think we're at the point in the review here. It's good that they're reaching out and working on some financial literacy using cartoons, maybe speaking a little too slowly, even though they're articulating, and looking at some fundamentals, but there's some flaws. Debt versus a loan. There's a very technical, generally accepted accounting principles definition that most people get wrong that lead them to think improperly about borrowing money and what's good or bad. Cost of money is not really talked about in here. What can you earn versus what you pay, and understanding like what is it that you really want when it comes to your finances and when it comes to your life, so that you can be more efficient and then expand. And so those are just a couple things I would add to this. Overall, I think that this is, got some merit. It's just not quite in alignment with the philosophy of I Am Money and what I'm teaching out there. So this is my reaction.
Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from. So go ahead and click through and watch the next video now.